I'm darn proud of us today, Jason. And you know what? Most of all, I'm proud of you because I don't think I've heard someone make as many excuses as you did in the last 2 hours about reasons we shouldn't record. You even tried to blame it on Tyler.
You're such a sellout, man. You're such a sellout.
We're here. No, I'm proud of you. I'm proud of you because I get it that Thanksgiving hangover lasts all weekend. So, but we're here. This is the post-Thanksgiving show. We're doing it at noon because this is when it fit in the schedule. And look, today's a half day in the market anyway. So it's sort of our normal schedule when you really think about it, an hour before close. So let's get it going. Welcome, everyone, to the Pirates of Finance. That handsome man next to me is Jason Buck. My name is Corey Hofstein. We are your hosts. This is the show that talks a little bit about everything: entrepreneurship, finance, markets, whatever we find interesting at the time. But what it is most certainly not is not advice. So don't come listening to two guys on a Black Friday talking about whatever we're going to talk about. Both of us really don't have much of a clue what this episode is going to be about. Looking for advice. Talk to a professional. Definitely don't get it from us. And with that, Jason, I want to kick it off with, first and foremost, how are you feeling? Because I know the last week has been a little rough for you. You were doing some travel. You got a little. You know what's interesting is everyone I'm talking to who's traveling is constantly telling me about how sick they're getting, just because they're. I think the immune system's not used to it.
Well, what I'm really trying to do is I'm trying to get my voice to a deeper baritone like yours. So, but instead it sounds just froggy with the phlegm.
Just gets scratchy.
The quick housekeeping, Tyler, I'm not sure if this is the 2-shot you want. If you want us to go full screen, please click on that yourself. There we go. I didn't know it was easier for him. I was like, this doesn't look right. Nor do I. Well, I don't want this big of a close up on my face though either. So that's just life. But yeah, to your point, we were in Cayman together. On the way back from Cayman, I caught some sniffles, stopped by your house, tried to infect your entire family. And then I was up in the Northeast. And when I flew back across the country, somehow I thought I was recovering from my cold, that then turned into a sinus infection. And I was bedridden for a few days. And that's why I unfortunately missed last week. But it's what I always think interesting about that, not to get into any sort of like woo-woo territory, is like, we push so hard. And then eventually our body's like, bruh, I'm not doing this anymore. And it was like, I'm going to put you in bed. What you could have just laid in bed and been fine and recovered on your own. But I'm going to give you a sinus infection. You're going to slow down for a little bit.
And the body eventually takes you out, right? You get so worn down, you can't fight those infections. So, all right, happier topics.
Please.
It's Black Friday.
Oh,
any exciting deals you're looking at? Anything you're shopping for the holidays? Not that I'm pushing mass consumerism on you.
Yeah, seriously, you are. That this is one of the nice cascade effects of me living out of just 2 suitcases, and that's all my worldly possessions. Is I don't have like any of that consumerism bug at all. And I never even think about Black Friday. Like if I have to like walk by stores on a main street or in a mall, it's interesting now after all these years, it has like zero pull on me. I have like zero interest because I'm like, oh, if I buy anything, I'm gonna have to take something out, put one in, take one out. And I'm like, I don't feel like taking anything out yet. So I don't have any of that consumerism. But I do know you had your eye on some fine pirate sweaters that you were hoping would go on a Black Friday sale. So how's that working out for you?
They did go on a Black Friday sale. So
do they have your size though?
Well, so first let me give a shout out. Long Wharf Supply Company is where we get these. We're not sponsored in any way. We're not affiliated in any way. They do have a Black Friday sale going on right now. I think there's 2 codes. One is the first 100. If you're one of the first 100 orders, I think it's 30% off the total. And then the second one is the Gobble Wobble, which will give you 20% off for the rest of the day, I think. But for those of us who were fortunate enough to order these before, we were on a mailing list that gave us heads up yesterday for a 30% discount. And I went to use it and it did not work. My order went through and I did not get a 30% discount. And you may and it was one of those situations where you apply the coupon code and it's like, this coupon doesn't work. And I was like, well, Corey, why would you continue to apply? Why would you keep checking out if the code didn't work? And the problem was what you said, the sizing. I need an extra large. And they had like none in stock. And so I went back 10 minutes later and I checked and there were literally 0 in extra large left, but I had 2 in my cart in another tab. And I was like, maybe they're reserving these. Let me just try to check out. So I checked out, I got them full price. And then I emailed them and I was like, hey, I took these screenshots. The coupon code didn't work. They just refunded me 30% back, which was awesome.
Nice. You gotta love when a company does the right thing. That's why it makes you really want to give them a shout out when they.
Yeah, well, and I was like, let me explain why an idiot like me would order this even though the coupon code wasn't working. Because that does seem a little stupid, but we got through.
One of these, well, yeah, and we're trying to still find that angle or that wedge in there for us to do some collabs, Pirates of Finance collabs with Long Wharf Supplies. Right. We come out with our own sweaters.
That's right. We got to really drive a lot of volume to them, a lot of business, so that they'll make a special one of these. In fact, I would argue that between me and you ordering these alone, because I'd have to order a whole new wardrobe of these.
I mean, yeah, between the two of us, so far it's half a dozen. The other one, I know we talk about privately a lot, but Represent Clothing Company out of England, the two Heaton brothers there, I love following everything they're doing. And they were the latest episode, we're getting prepared for the Black Friday sale. And they were talking about how in the past, like everything's sold out and everything, but they found what they believe is the best, like 3PL logistics company in the business. And it's like, I mean, just tens of thousands of units in stock and spending weeks leading up to Black Friday of like how they're going to handle all of these orders coming in, trying to find temporary employees to help even the stock. I mean, obviously it's a pretty robotic 3PL facility, but it's fascinating to see a company that's trying to scale at decent size, but then trying to aggressively scale. And not only do they launch a Black Friday sale, they also launched their new collection on Black Friday as well. So these guys are just glutton for punishment, but I just love the way seeing how they're building their business. In the latest episode, you can find, I think it's like Behind the Brand or something for Represent on YouTube, but they go into even like their logistics and how they break it all down for Black Friday.
I was going to say I always sort of laugh at the Black Friday deals because it's not like there aren't other amazing deals throughout the year. Like it's not, to me, it's not the same as it used to be. Not that I was, 20 years ago going out and buying televisions or whatever, but I feel like this sort of like Black Friday thing is, I don't know. It's like you get just as good deals throughout the rest of the year most of the time. But you make a really interesting point about like in the world of technology and asset-like businesses, a lot of stuff can scale very easily, right? You want more web servers, you can spin them up on AWS in a very dynamic fashion. That's not true with human capital, right? And physical assets that you need to manufacture. So there's this interesting lead-lag relationship between expecting the demand, how much inventory you have to carry, how many people you have to temporarily hire to meet that just-in-time demand, and then the reputational damage if you don't handle it all very well. So it's interesting. I'll have to check out that episode. I want to make a hard pivot, though.
Oh, man, you're going to jump right in. All right, go for it.
I'm jumping right in. No, I'm jumping in with something light and breezy and easy for you. And I got this from another podcast, and I love the format, so we're going to try it. I want to do a Thanksgiving draft with you. So I want you to, here's what we're going to do. We're going to go back and forth, and you can draft 5 foods from Thanksgiving to build your team. So, for example, you might start the draft, but if you take it, I can't then take it.
All right, but man, this is gonna be weird. All right, so I have to go first, and you just first round draft.
I can go first. I think it's advantage to you to go first.
Well, you're gonna be surprised, I think. By all mine, I don't think we're gonna overlap.
All right, let's see what you go with.
I go prime rib first.
Okay, you're right. I am surprised. Okay. Not what I was thinking. Well, I'm gonna go classic. I'm gonna go pumpkin pie.
Oh, man, that was a good move on that one. I'm just going with my favorites. I'm gonna go carrots.
What? Carrots? Are you serious?
They were so good yesterday. My girlfriend made some amazing carrots yesterday.
Prime rib and carrots. You're leaving me all the desserts right now.
That's fine. I'll always come up with something.
All right. I went sweet. We're going savory. I'm going stuffing.
Yeah. See, I hate stuffing, so you're on your own on that one. I told you there's gonna be no overlap. Now I'm gonna once again, I'm going Brussels sprouts.
No, I'm with you on that one. That was on my list.
Yeah.
That was on my list. All right, there's a special way you're making those Brussels sprouts?
Yeah, well, the latest one I saw the other day. Have you ever made smashed Brussels sprouts?
No.
So Tyler's gonna love this one with his air fryer skills. Have you ever made smashed potatoes? You cook them, you boil them, cook them, you smash them, and then you put them in the fryer, and then you olive oil and everything. Like that's the best way to have potatoes. But you can do similarly with Brussels sprouts. You can parboil them, mash them down, season them up, and then put them in the air fryer to finish them.
Well, that sounds really good.
Yeah. So we got to get through this, though. We got to talk about something serious. I mean,
this is as serious as it gets on Thanksgiving Friday. Look, for me, top of the draft pick. Actually, I'm gonna leave this one to the end. All right, so you did carrots.
I did prime
Right.
rib, carrots, Brussels
Yep.
sprouts.
All right, Brussels
You've got
sprouts is a
pumpkin
good one.
pie.
I'm gonna take turkey. I know this is a contentious pick because most people don't like turkey, but I think if you do the turkey really well, like if you're good at cooking a turkey, you can get it to come out very juicy, and it's a perfect delivery vehicle for everything else on the plate.
I would, except for like you just said, 99% of people don't know how to cook turkey well, and so it's usually terrible.
I'm a big believer you got to spatchcock it, and I know most people don't think that's a word, but if you
can
got to
get-
you got to take out the spine, you got to break the rib cage,
Yeah.
flatten that bird out. It takes half the time to cook, and it's going to come out way better. And look, no one gives a shit about your perfectly beautiful oven gold turkey when it comes out. No one sees it. They're just seeing the carved meat anyway. So just cook it well.
No, you're dead on. The best ways you can do it traditionally, like you just said, is if you brine it, you spatchcock it, and you put the butter over the skin and under the skin, you're going to get like the best results on a classic cooking technique. Otherwise, you can break down the individual parts and cook them individually because that's what they need. And that's what you're basically doing with spatchcocking.
Right.
You're making it more an even distribution for the cooking surface. And that's what's key. Obviously, fried turkey is probably the best, but like those are the different ways of doing it. But this was actually my number one draft pick, but I knew you wouldn't even go for it, is I ate a quarter of my body weight in cornbread yesterday.
No, that's a good one. See, what I think is interesting about this discussion, though, is cornbread is not for me a traditional Thanksgiving food.
Right. That's why I knew you probably wouldn't go for it.
This is very regional, right? I was thinking about this, like macaroni and cheese is never going to be on my list. It's going to be it's a Southern staple.
Right.
So we got some regional, like we got to understand I'm a New Englander, right? So I'm clearly for number 4 going cranberry sauce. I can't not. Homemade cranberry sauce, like with that perfect amount of tang and sugar.
Have you ever been to any of the cranberry bogs in the Northeast? I've always wanted to see them.
Oh yeah, there's a whole bunch right around Cape Cod where my parents live.
Do they just float along the water like that, and you just kind of scoop them up? But like, how does that work?
Yeah.
That's amazing.
Come visit.
We'll
go on a bog tour.
Yeah, that's what you call it. We go cranberry bogging.
Yeah, we'll go bogging. We'll go cohogging, and then we'll go bogging.
This is so ridiculous. 5th draft pick. Oh man, you went cranberry sauce. Oh, I gotta go dessert. I go apple pie over pumpkin pie all the time.
Yeah, that's a good one.
I'm an apple freak.
So this is where, all right, 5th draft pick for me. This is where I knew you would never take this, so I knew I could keep it 5th. Hermit cookies. Now,
I saw the thing at your house. No, I saw the frame thing. So you got to explain what hermit cookies are.
All right, so hermits are a type of like molasses ginger cookie that my family, I consider it a family tradition. I thought it was a secret Hofstein family recipe passed down through the generations. Turns out my aunt just found it in a magazine one day and started cooking it. But then my mother learned it. My sister knows it. My wife has made it once. It's really like in the holidays, my mom will make them or my sister will make them and bring them around. But they're like this super gooey molasses ginger. It's got a nice bite to it. It's like to me, it's the perfect cookie, and it tastes like the holidays to me. So there's my list. Those could not have been more different.
I have to think about that combo, but I'm usually in. I love ginger, and then molasses. I'd love to see the taste because, man, weird story for me. I was my nanny growing up with this hardcore German lady, and she wouldn't even let us drink water while we were eating. And our dessert was blackstrap molasses and milk, and I actually loved it.
Why is it every time you tell me a story about your life, you just become a more ridiculous human being? I shouldn't be surprised, but you're like, yes, my German nanny made me drink milk and blackstrap molasses. First of all, that unique combination of things, to have the German nanny.
I don't know where she came from, but man, she was mean. It was, and the whole point was too, the more ridiculous point is you couldn't drink water and anything during your meal. That was another one of her staples. But at the same time, hydrated. To pull it and then just to make it more ridiculous for you. I always wondered, do you just think I'm you picture Royal Tenenbaums or something like that?
Yes, 100%. As I learn more about your life, it is the Royal Tenenbaums.
And then she would also make us lay on the floor like snow angel style and do meditations. And this is in the early 80s in rural Michigan. So we'd have to lay on the floor for like 15-minute meditations like snow angels.
The things I would do to get in a time machine and go witness the young Jason.
By the way, I didn't know I was weird till much later in life, but like this all starts to add up for you, I think. By the way, I thought you were going with I'm gonna jump in and interrupt you so you can't get another question. But when you're talking about physical, we were talking about lead lag, physical inventories, and we could go on forever about lead lag and what that means for inflationary purposes and everything. But this morning, and might catch you off guard because I don't know if you prepped for it. You sent me one of the business breakdown podcasts on Brookfield.
Yeah.
And I haven't had a chance to listen to it yet, but I'll just tell you what I know about Brookfield, and then hopefully you'll provide a lot more better information of what's probably wrong in my head. Obviously, Brookfield is like one of the largest, if you want to look at a PE, but it's really commercial real estate company, and it's been around for decades. And so what I always think about is actually Brookfield was founded, if I recall correctly, by the Bronfman brothers from Seagram's. And the first thing that popped in my head is like, what's that quote? Like every great like family dynasty or wealth is created off a great swindle. So that I'm just saying allegedly, but if you want to go up look at the Bronfman's history, it's kind of fascinating how Seagram's was founded and what the Bronfmans did. But they founded Brookfield under different names, I remember. But my point was, what's been interesting to me is it's really a story of compounding, right? Like if you have 5-6 decades to grow a real estate portfolio, well, 6 decades later, it's gonna be massive as long as you haven't blown up. So that's one of the keys. And then the other one that I would think about is what's his name? David Platt is the CEO. Is that right?
Yep.
He's I would argue, one of the most underrated CEOs in America. Like everybody knows all the other big CEOs and all the big private equity firm CEOs, but like nobody really knows about him. And if I remember, he's the one that's really stewarded it for the last 2.5, 3 decades, somewhere in there. And has really stewarded their growth to here. The one thing I've always wanted to dive into that maybe if you listen to the pod, you can help me with is that they have an interesting cascade of different vehicles, and the way it works up the org chart structure, like hierarchically, it's a very interesting structure that I need to dig into as we build asset management firms.
Yeah. So this was a really great episode. As you said, it's on business breakdowns. It's all about Brookfield, one of the largest asset managers in the world that most people have never heard of, right? You've probably heard of the KKRs and the Blackstones. This is another one of the big, great ones that most people don't know. Jason, I think, just left to let his plumber in. So this is now the Corey show. I guess I'm going to try to fill in the gaps. I listened to the episode this morning when I went out for a walk, and Jason is right. The episode talks a little bit about the history, but it talks a lot about what makes them unique in comparison to their competitors. And I think there is a large element of given enough time and given enough permanent capital, which is a huge important part about the way they develop their structure, right? They have all these sub companies, but it's developed in this manner of permanent capital that allows them to deploy at advantageous times to unique projects all around the world. I think one of the interesting tidbits I picked up about the project, so that they try to focus on, is having real earnings growth. They avoid cyclical industries just as a hard and fast rule, right? They sort of say things like mining can be a trade, but it's not meant to be a long-term investment because they need things that are structurally advantageous for them, that they think they can really generate meaningful, true, real earnings yield from, and not have it be a cyclical play and risk having the leverage bite them during a cyclical downturn. But one of the other interesting things that I picked up, and again, this is a podcast I got to listen to a couple times, was they were talking about the compounding effects of a brand. That when you become a large asset manager, it snowballs in itself, because this is an industry where brand is a moat. That it's hard to be an emerging institutional manager, because what institution wants to take a swing on an unproven entity? So when you get to a certain depth of history and a certain scale of size, it just invites more assets. And then the company itself is set up in a way where, like, those assets ultimately end up being a long-term annuity stream that they can then reinvest, again, in a very permanent capital way. It felt very Berkshire in its setup, but focused much more on, as you pointed out, real estate and infrastructure projects, right? They'll go in and buy a toll road in Brazil,
But like you said, it's cumulative advantage, right? And I don't think people realize, you and I kind of talk about it a lot on the show, is like the idea of whether you're going to start an asset management business, whether what asset class you're going to, be in. What matters at the institutional level, which you were starting to hit on, is brand advantage. So everybody at the institutional allocator level is only interested in CYA. And so they're always going to go with the larger institutional firm that's been around the longest. And so that's why how they can say, well, it wasn't our fault on the real estate play. We were invested in Brookfield and they were the best in class, right? And they've been around for 4 decades. Same thing, like you're saying with Berkshire, with Howard Marks at Oaktree. A lot of this stuff is like, oh, it's just CYA. And this is really happens where you get winner take all effects in VC and PE space as well. So whether it's BlackRock, Blackstone, KKR, and then even on the VC side, that's what people don't realize with like Benchmark, A16Z, is the capital aggregates to these people, not necessarily because they're the best, they might be the best, but just because it's who can take institutional size as well. Because that's the other thing that Brookfield's taking advantage of, right? I think they got to be hundreds of billions. What are they up to? Like, do you manage? Anyway, so
the
who
number
can
that's
deploy
in my
that
head
capital
right now is like 400 billion, but I think it might be bigger than that.
Yeah. So if you're any sort of institutional money manager and you're managing hundreds of billions or trillions, and you guys decide at your investment committee meetings, we need to move another 2, 3, 5% into real estate, where the hell are you going to put it in the next year? You need somebody to deploy capital at that size. But what may be interesting, I don't know if this is on the podcast or if you dove into this at all, is like, how much have their returns come down at size? Because there's, once again, it's capacity constraint, there's granularity issues. Granted, it's nice for them to be able to create a market out of real estate, because that's like, we always talk about, we have all these liquid asset classes, but the largest asset class has illiquidity and granularity issues. But also, I would assume, like, with the size of the projects they're doing, are they still able to deploy, tens of billions, if not, $100 billion in a year?
Yeah, so they didn't talk to recent returns. One of the things they commented on was with the longevity of these projects. Right, the CEO has said in the past, the purchases they made in 2009 set the tone for the next 15 years. Right. And so I think the big open question right now is, what does a normalized interest rate environment do to their earnings power for a lot of these infrastructure plays that have some component of debt to them? And again, I think they've tried to focus on plays that can maintain a real earnings yield, right? Growth that they can pass on that increase in inflation costs to the end consumer, whoever it is. But there's always lag effects there, and it's not perfect. So it'll be interesting to see how it plays out over the next 5-10 years for them. But that is sort of the horizon you need to evaluate to determine whether they've been able to successfully manage these projects.
You love all my dumb ideas that aren't thought out because you love to make fun of them. It makes you laugh. But I was really wondering, I had this epiphany the other day that haven't fully thought through. So work with me on this. Is like, when we talk about Harry Brown's permanent portfolio, I always thought CTAs were better coverage for inflation than gold, right? It just gives you higher probability, right? And gives you much more dynamic strategy and multiple asset classes to cover an inflationary environment that the way Harry Brown thought about it, at least in his 4-quadrant model. I've always had a hard time with bonds. You and I have talked about bonds a million times privately. But especially as being a former commercial real estate developer, it didn't make a lot of sense for me to buy bonds if you can have all these value add services on top. And I start to wonder now, in the Harry Brown 4-quadrant model, if bonds are your play for a disinflationary or deflationary environment, is it maybe better, almost like using CTAs for broader diversification? Would it be a broader diversification to use all these different commercial real estate developers and investors like Brookfield, get broad diversification there? And not only would you do well in a deflation and disinflationary environment because your cap rates would explode, at least on the value side, but on the inflationary side, you'd also still have some protection because you can try to at least keep up with a lag to inflationary pressures, depending on what asset classes on the real estate side you're into. So I'm really wondering if you get a broad diversification of the asset class, is that a better asset class than using bonds for deflation side of a Harry Brown permanent portfolio?
Yeah, I mean, it's an interesting question, right?
Blow up risk though too.
Right, you got the blow up risk. I think it's, again, going back to the permanent portfolio or the all weather Dalio quadrants, right? Which is Dalio was basing his work on Harry Brown's permanent portfolio, right? Are you really trying to isolate what's going to do well in that quadrant? And I think you have to look deeply into Brookfield's investments to determine whether there is any inherent cyclicality built in there, right? Because then it's not really built for a deflationary environment. So I think Jason is frozen and gone. So we're just going to continue the show here. I will say we did plan for a 30-minute show. Hopefully Jason's going to join me. But one of the topics I wanted to pivot to from this conversation was a piece that I sent Jason about from McKinsey, sort of on the same topic of building an asset management firm. The piece is called The Great Reset, North American Asset Management in 2022. And it was all about building an all-weather asset manager, right? So we talk a lot about building all-weather portfolios. This had a lot of the same concepts, right? But it's not just about the portfolios you manage. It's about the actual structure of the portfolio asset management company itself. And there were two things I really wanted to point out from this particular piece. The first was about this interesting scenario analysis they did based on historical precedent. And they talked about three potential scenarios going forward, economic scenarios: a soft landing, stagnation, and stagflation. And I thought what was really interesting was in the soft landing scenario, they talk about AUM growth being in the 7 to 12% compound range. They talk about flows being in the 2 to 5% range, revenue growth being in the 5 to 10% range, right? The nice thing about an asset management firm is that you are earning that annuity on the capital base typically, and your equities and alternatives would likely do well, and fixed income and money market would be sort of a push from a growth perspective. Stagflation, though, what I thought was most interesting was they talked about how asset growth was going to be negative 7% to 0%. In other words, as an asset manager, you should expect outflows, and you should expect annual net flows to be negative. You should expect your revenue to be down. You're going to see losses in equity and fixed income exposure. And really, it would be alternatives, again, that would be positioned well for that environment. So a couple takeaways here for me, thinking about an asset management firm. One, you need to maintain that diversified base of offerings, right? If you are only an equity firm and you're a nascent player, unless you can find permanent capital, you are highly subject to the whims of what's happening in equities. And if equities have a 50% drawdown, your revenue has a 50% drawdown. So that can be really difficult to navigate from a firm perspective who's trying to manage, variable revenue with fixed costs. So the more stable you can make that asset base that you can draw from, the easier it is to build those fixed costs that can help you compound the growth of the business. But the second thing I really want to point out, and I thought this was really interesting, was that stagflation scenario they talk about, that the AUM growth was going to be negative, right? We don't often think about negative AUM growth because there are these components, at least in the United States, of incentivizing people to continue to contribute to financial markets. 401ks, for example, defined benefit plans, right? All this sort of stuff that is using the markets as a retirement vehicle, whether it's self-funded or corporate funded or a public pension plan, for example, continues to put flows into the market. And yet what McKinsey is saying is that the asset management space would see net asset outflow. It's hard to say from why that would be true at the broad space, but at least at the individual asset manager space, one of the things that I see all the time is that when markets get chaotic and you see losses, you are just much less likely to see inflows. It's a period where you see much more dramatic likelihood of sudden outflows, people panicking, people going to cash. And then even worse, if you are the fund that did incredibly well during the period, you're typically the strategy that's getting rebalanced out of for your investors to opportunistically allocate to things that are perhaps on a fire sale. And so it is interesting thinking about from a planning perspective as an asset manager, how to navigate perhaps a prolonged stagflation environment where you might not expect to see meaningful inflows. You might see some in particular divisions of your business, maybe in alternatives that you offer, but equities and fixed income might be a space that you actually continue to see outflows as people tax loss harvest or just get fearful of making any changes in their portfolio. They're just less likely to put fresh capital to work. They want to feel those bullish animal spirits before they take their hard-earned cash and put it in the market. And that's just one of the things that can make it very difficult to navigate a continued stagflationary environment for an asset manager. Jason, one of the important things I've learned now that you're back is I don't need you to do this show.
Apparently not. Can you hear me at least?
I can hear you. Your screen is completely black, but thank you for joining us.
My internet completely shut down. So my apologies.
All
Man,
good.
I know you never needed me for the show. I mean, you could just always do this on your own.
Listen, the viewership numbers went from stellar to they literally dropped off a cliff as soon as your screen turned off. So clearly I need you. I was talking about the McKinsey piece that I sent you. I don't know if you've gotten a chance to read it.
Oh, yeah. Yeah, I was definitely at least skimmed through it. So, yeah, I was curious actually what you wanted to highlight in that piece.
So there were two things, and I've already highlighted one of them. So the first thing I wanted to highlight was the scenario analysis they did about being an asset manager in these different economic environments, soft landing, stagnation, stagflation, what to potentially expect from an asset growth perspective and what that implies for revenue growth. And I just think, again, it's interesting to be an asset manager and think about how much your revenue is tied to flows and what happens to the underlying sort of aggregate portfolio that you manage, and how you need to position yourself potentially if you're trying to build a very stable asset management firm. But the second, and I don't know, this was the one I thought you would have some interesting views on, was the idea of building an all-weather firm, not just an all-weather portfolio, but like the components of building an all-weather asset management firm. And it talks about not only the strategy offerings that you might consider, so diversified alpha, alternative beta, tactical overlays, but also different portfolio solutions. So, are you focusing on inflation protection, yield generation, liquidity, growth, customization? Can you offer model portfolios or some sort of tax efficiency in your offerings? Can you offer them in some sort of ESG capacity? And it was talking about using all of these different components to diversify your business lineup so that you could be more all-weather depending on, which way the wind blows. And I think it's always interesting to think about not just all-weather from a portfolio construction perspective, but all-weather from a business perspective.
No, I thought that was fascinating. And obviously, I would assume you're thinking about this because the way Brookfield's built its business, right? It's very diversified business that Brookfield has. And so that's when I was going through there. I thought, yeah, it was twofold. It was, do you build all-weather strategies and that's what keeps you in business? And or, how do you build out your business? I thought it was pretty light on how you go about it, building that business that way. But as you know, we offer a total portfolio solution because I think that's the way to have sustainability in your business, especially if you can use, go ahead.
I was going to say, and I think it ties back to your, I don't know if you've really talked about this publicly, but what you do with the balance sheet of the business as well, right? That's another big question. As an asset manager, particularly if you manage an ETF or a mutual fund, typically the fund board wants to see you holding a ton of cash so that you can prove you can meet the fixed expenses that are necessary to run the business. That's part of their oversight. So the question is, as an asset manager, what do you do with your balance sheet, knowing that your revenue is typically cyclical, right? It's tied to what's going on with broad beta. Well, that's not true, right? If you run an all-weather portfolio necessarily, you might be somewhat cyclical, but not always. How does that change your ability to use your balance sheet or reinvest your balance sheet? All of this stuff is a really interesting question about how you manage an asset management firm for longevity.
Yeah, by the way, I'm purposely not black camera. I can't figure out how to get the camera to work when I was just jumping back on with my phone in an emergency.
I'll tell you the real concern I had was going, I think your phone's not working, Tyler's in the car, and I don't know how to shut off the screen. So I was just going to have to keep talking until someone joined me.
Yeah. But going back to your question, yeah, I think it's our buddy Matt Faber wrote a great piece called, that financial advisors are quadruple levered to the S&P 500. Whether they're looking at their business, their balance sheet, their clients, and then the growth of their clients, especially at management versus incentive fees. And like you said, it's incumbent, I think, depending on the portfolios you're building, and most people's portfolios are implicitly short volatility. Then, like you're saying, with your balance sheet or your internal treasury or whatever, you might want to consider having some long volatility assets. And that's how you could balance out to make sure you survive. And I think that's what more than McKinsey was kind of saying. Like, so for example, if all your portfolio is just long stocks and bonds or however you want to structure it, then you might need some CTA or long volatility or tail risk protection to make sure you can ride out through these economic times, when your portfolio is taking a hit, then you're losing clients, and then therefore your business revenue is taking a hit. I mean, it just cascades all the way through. And so you want to think about robust portfolio construction in that sense. But as you know, I've asked you a million times, like we've talked about this often, it's like if you build a total portfolio solution, a robust portfolio, should you also be holding that on your treasury or your balance sheet internally too? Or now, so now you have that double leverage risk to the returns of that portfolio. But if you feel it's really diversified in robust, then where else should you put that capital? Like, should you really then diverge into maybe private alts to give yourself a maybe somewhat uncorrelated return stream? Or are you okay seeing how you built a robust portfolio and that's what you're offering your clients as well?
Well, I think there's a question of what should you be doing with the corporate treasury and what should you be just distributing to members, right? Like just because you can buy it in the corporate treasury, the question might be, well, if you have all that cash that all of a sudden you're thinking about making private investments, is there a benefit in doing it inside the corporate structure? Or why not just distribute all that cash to, right, in the individual entity holders, right, the members,
Yeah.
and let them make their own investment decision. All right. A lot of the way I think about there's necessary cash on the balance sheet I have to maintain. Then the other question is, do I have reinvestment opportunities in the business that I think are going to outstrip the portfolio that I can build on my own individually? And there are some years the answer is unquestionably yes. I think that I have massive opportunities to reinvest in the business at a much better rate than I could earn in the market. Then there's other years that I've said, actually, no. I think the next 2 years for my business, for whatever reason, are going to be lean years. And in fact, maintaining just cash on the balance sheet as minimum as possible, keep spend down, keep expenses down, and wait for the fat pitch is the way to go. And then because I run an organization where it has very few actual equity holders, we've all sort of agreed that, if necessary, we can call capital back, right? Just get the cash off the balance sheet so we don't think we're fat and happy and rich, get it to the individual equity owners. And then if we think there's a real meaningful reinvestment opportunity that we need to claw some of that capital back, we can always ask the members to recontribute. And so it's all about how you want to run the business. But the question I ask myself all the time is, why would I do this necessarily on the company balance sheet versus just distributing it to members?
Well, there's two pieces in there though that I think you drew on. One is, we talk about this all the time. How much do you take out of your business, right? How much do you pay yourself? What do you do with distributions to not only you but the other GPs or your even employees? And that's always a question. How much dry powder do you need versus, how much do you want to distribute? And we've talked about a lot of times. I think a lot of people, you should be reinvesting in your business as much as possible. You should be keeping dry powder as much as possible. But at the same time, people should also consider actually taking money out of the business. I think it's come in vogue lately to say, no, I just put all my money back in the business. Well, that's a fancy way of saying like you have a failing business and you don't pay yourself well. And so what's going to keep you in the business? If you're just reinvesting all back in the business and the business fails, because we're still decision making on our capacity, and you may be investing back in the business, but maybe those end up in hindsight being malinvestments. Because I hate the term malinvestment because you're decision making under opacity. You think it's a good investment. Only in hindsight do you know if it was a good or bad investment, and there's macro factors involved. So that's really the question you come back to is like, how much should we basically be taking distributions? How much receive for the company? The other thing that I think you highlighted that I don't think people realize that I think is fascinating is it really depends on what vehicles you're using to run your asset management company. And I think that was maybe what the McKinsey was getting into as well. It's like you just said, you have regulatory constraints on how much capital you have to carry on your balance sheet when you're running an ETF or a mutual fund. We don't have the same in a commodity pool operation. Other people don't have the same, private equity or VC. It really depends on what you're running. And this almost ties back into Brookfield in a way. But correct me if I'm wrong. They manage a bunch of like publicly traded vehicles, but then they aggregate them up into like at the corporate level, and then they're able to take like leverage on leverage. So I was thinking about how that cascades, and maybe what they do is they say, hey, this is where we could get hurt in a recessionary environment or a liquidity cascade. So let's build a vehicle that helps us manage that, and then they aggregate it up at the corporate level into their portfolio construction.
So my understanding, and again, I listened to the episode once, and there was a lot in there, and I was walking, so I wasn't able to take notes. But they basically, the underlying corporate entities are the ones that make this project-specific investments, and they raise capital from institutions. So you can think of them as like one-off investments or niche funds, at least. And then the parent company takes 70% of the carry where the child, and then the child entity keeps 30% of the carry that they charge their investors. And so this parent company is constantly, pulling this annuity stream from all the child companies that they spin off. But to go back to the structure, right? I think you're right. It is structure of the portfolios you manage, right? ETF versus private vehicle has different needs from a board perspective. What they're gonna want to see on your balance sheet. But two, Brookfield is run as a public entity, right? That you can buy shares of the company, whereas like NewFound, the company I run, is a private entity, and I'm not creating that permanent capital structure necessarily, right? I'm not. So again, I go back to the question of like, why would I use capital on NewFound's balance sheet to buy commercial real estate? That's totally independent of what NewFound is created to do. Why wouldn't Corey just distribute cash to himself and make those decisions in his own personal portfolio? I think it's always interesting to think through like the Buffett structure, which is I'm going to do everything in this permanent capital vehicle, and I'm going to put 100% of my net worth into buying shares of that vehicle, versus I'm going to run a vehicle that does something hyper niche, and then I'm going to distribute cash to myself to diversify in my own personal portfolio around that.
Yeah, you and I had this argument before where sometimes I feel like being intransigent a little bit. I feel like that we shouldn't have personal portfolios. Like we should we shouldn't have PAs. Like we should have to build the stuff we want. That way we can offer to our clients as well, and that forces us to be better entrepreneurs. I mean, obviously it's extremely difficult. You're running niche strategy for capital allocators, and that's the way kind of our world works. Is the more niche strategies you run, that's the larger institutional capital allocators prefer, because they prefer to create their own portfolios, unless us doing it for them and creating a total portfolio solution, it limits your marketplace. Not a lot of people want access to that.
Right.
By the way, Amit's asking, he joined late. Why can't he see me? It's because the show is not run by professionals, and we go at whatever time we want. Well, I should say it's I'm the unprofessional one. I had my plumber come, but I interrupted this stream, and then my internet went completely out. So I joined via my phone, and for some reason, the front-facing camera on my phone's not working either. So this is how we're doing. You probably hear birds chirping in the background, leaves crunching, and hopefully you just listen to Corey the whole time, and I'll just shut up. But going back to the one though, that do you think the tangential way I would think about it too is Brookfield is creating that portfolio that McKinsey's talking about, in the sense too that they create publicly traded vehicles, which allows them to have permanent capital, so they can ride these out, especially when the underlying assets are illiquid, asset classes that spit off cash flow, but they need that permanent capital overlay. So when you say it's also about the way you structure your business, and whether you're using ETFs, mutual funds, a larger DP, LP, private placement, all of those things matter.
Yeah, I mean, I think you and I have discussed this a couple of times. Where I think the question that is always in the back of my head is, how can I get permanent capital, and how can I get float? Right, and if you can figure those two things out, right, you're unlocking a huge hack in many ways, particularly now that interest rates are somewhat interesting, right? But if you can get float and you can get permanent capital, those two things give you a lot of flexibility that you don't have in another structure, right?
I just love that. Like, no problem, just get float and permanent capital, it'll be good to go. It's like, yeah, of course, but how do I get that? And I think
that's the hard question. How do you unlock that in your business?
Well, and that's why I'm always looking for some, alternative ways of thinking about float. But and I would just want to point out, everybody says that because of Buffett. What people don't realize, yes, he eventually got that with Geico, but there's probably half a dozen other opportunities for float that he had that didn't work out, where they didn't get their insurance costs right. They kind of blew up that side, so to speak, or they tried, companies like Blue Stamps or everything else that didn't, wasn't a longevity business. So it float is a lot harder than people realize, and especially if we can't control that entity like Amazon can with Prime. It's like, where do you find float? Where do you find permanent capital? So it's about your structure. The other one tangentially I think about with you is, like you and I talked about, is I wonder, if I'm building a private placement fund, and maybe I'm concerned about ETFs overtaking, active completely one day. Do then I invest with like an ETF firm like you? And that's a nice hedge for like thinking about the overall structure of the business. And I'm also thinking about where my competitors are going from. And then even on the very fringes of that, is it, everybody wants to shit on crypto, obviously, this week, but is it a crypto securitized token, NFT? Is that what disrupts our business? So how much do you think about where the disruption may come from, as well as you're building out the robustness of your cash flow.
Right. Well, and how much of that again should be something that you invest in yourself versus something you should invest in for your LPs, right? If you run a fund that's supposed to be all weather and you're concerned about being disrupted by a different structure, right? You might say, I want, as Jason, to invest in a number of companies offering ETF portfolio solutions, and that might be interesting for you to hedge your business risk. But is that the appropriate thing that you should be using investor capital to do? It's always a hard question. And again, I think the more you run a limited mandate, sometimes these things are easier to sell, but they again limit your opportunity set. So by the way, I'm realizing now with you on your phone, and I have no idea where Tyler is. I think he said he had to jump in the car. Do we know how to end this stream?
I don't know. Maybe Tyler can jump into the comments, because at least I can see those, and he can let us know if he's in a place where he can actually end the stream. But also, I want to pull up, because it came out in the comments from Amit. I actually thought about this the other day. How do you feel like? I don't think you could talk about it, but maybe you could talk about this aspect of it. I saw on Twitter that people can leak your ability to launch ETFs, and I'm like, man, when I saw that, I said that sucks for Corey. It's like people are already leaking that you're going to be launching ETFs in the future because you had to file for them.
Yeah, look, so I have to be very careful about what I'm going to say here. So SEC filings are public. And so there's nothing wrong with that, right? People see the filings, they see the intention. I think what people should be aware of is there's a review period, and initial filings are not final filings. They get the chance to be revised over the filing period. But typically what you're trying to do is start a clock, because there's a minimum review period of 90 days. And so if you want to get a fund out, like a mutual fund or an ETF, you need to get that filing done. And then the earliest effective date is 90 days after that. So you can see the earliest and subsequent filings. What happens, though, for the firm that files them is it's considered a securities offering, and you go into a blackout period where you are absolutely not allowed to talk about what it is, because it's going to be considered a pre-sale of the security, and that's clearly not legal. So until the filing goes effective, you really can't talk about it. But the reality is it's hard to talk about this stuff anyway. It's a highly regulated industry, so even if it goes effective and I'm not in the blackout period, it's very hard for me to talk about, because anytime you talk about a fund name or ticker of which your advisor, sub-advisor, fund sponsor, technically for ETFs and mutual funds, FINRA needs to review it because it's considered public marketing. There's a whole bunch of marketing carve-outs, but like if I'm tweeting something, like that's going to be considered public marketing to a certain extent. And so FINRA then has to review my tweets, and it's an interesting, like, I don't talk about any of the funds I manage on Twitter. I talk about strategy concepts and ideas and debate all that sort of stuff, but it's just from a compliance and regulatory perspective, it's really hard to navigate that stuff. But to your earlier point, no, I don't mind if people see the filings and want to talk about it. That's totally fine.
I know, but I was just thinking, like, you have your business timeline, but you already knew that was going to be in there. So you knew as soon as you filed that somebody was going to leak it, probably. I mean, because that's what a lot of people follow. And we're not saying leaking it in a bad way. It's just people follow that and launch it. And then it also gives you some pre-marketing, as long as you premeditate that kind of timeline. And then I don't want you to mention the names or ticker names, but if there was some funny commentary in the thread about your filing too, that people talk about what you could name some of our funds. And I was joking is that our homie Meb seems to have every ticker name locked down. But if I remember, there's like a shot clock. You can only buy or reserve that ticker name for maybe a year or two, and then it goes back into the public domain. So I assume you already had ideas, and was it hard to find the tickers you wanted? And then I assume you pre-bought them before any of this happened, right?
So we actually haven't. So this is, again, going back to what do you need when you file? Like, you can file without tickers, and you can file without stated expense ratios. You can file with a whole bunch of details missing. You need the principal investment strategy. You need the key risks. You need to name who the sub-advisors are and what the general structure of the advisory, sub-advisory is going to be. But beyond that, you can leave a lot out. And so ticker is an important one. This is one I actually feel very strongly about, because there's a trade-off here. You want a ticker that's catchy and something people remember, but also if you are intending to build a suite of products that are all related, I'm a big believer that your brand has to apply to those tickers. So what I mean is, like, they shouldn't just all be random. There should be some cohesion to the suite. And so a lot of it is trying to figure out, is there a block of tickers that we can sort of grab that are all related to each other? Maybe the first 2 letters are the same, and it will explain what the strategy does with the ticker. Because otherwise, you
Dude,
end up
stop
with,
there.
like,
You're giving me hints. You're giving me hints. I'm already gonna lock them up, so you're gonna have to pay me for them.
okay, well, go
We're front
ticker squat. This is like the old domain squatting thing. Go ticker squat.
Exactly. Well, we could go on about this forever, but we're trying to do a shortened show today. I've obviously ruined it with all the technical difficulties. But as usual, this is not investment advice. Please seek out investment professionals. Want to say happy Thanksgiving week to all the Booty crew, everybody listening. For those of you not in America, happy Thursday, Friday in November. We have our own traditions here, I guess. As Corey and I figured out, we have very different Thanksgiving feasts today. Anything else you wanna add, Corey? Besides, we've got the U.S. England game.
Yeah, I was gonna
coming
say
up.
U.S. England game coming up. You place any bets?
Nah, no betting. And I think, that would be illegal in the state of California, Corey. So I would never do such a thing.
I never know where you are at any given time. Well, good. Well, go enjoy the game. Thank you, everyone, for joining. A reminder: Long Wharf, where we get these sweaters from. If you like them, they're doing a big sale right now, 20 to 30% off. Rewind this, you'll find the coupon codes. But thank you for tuning in. We appreciate your time. Big shout out to the Booty crew in the comments. Enjoy your weekend. Tyler.